I'm Deb de Vries, assurance partner at Anchin's Law Firm Services Group and co-leader of our firm's compensation and benefits practice. With me today is Steve Lando, tax leader extraordinaire of Anchin's Law Firm Services Group. Today, Steve and I are going to discuss pass-through entity tax economics, also known as PTET. In particular, cash flows and taxes and the impact on partners and shareholders. So Steve, can you give us a brief overview of the PTET?
Sure, Deb. So effective in 2018, Congress kept the SALT deduction at $10,000. As such, states began implementing workarounds to provide a full deduction to their resident individuals, as well as a full credit on their individual returns. In November of 2020, the IRS actually blessed the concept of the deductibility of pass-through entity tax regimes. And today, some 24 plus states have already implemented or at least proposed legislation for the pass-through entity tax regimes. But obviously, the rules by state differ.
So what are some of the differences between the states?
So the differences run the gamut. Everything from elections, participation, returns, composite returns, rates, withholdings, as well as overpayment. So, for example, the Connecticut pass-through entity tax is a mandatory regime. Most states, it's an election. For New York State, the election is due by the 15th day of the third month. Yet most states, it's actually due with the return. As far as participation, many states are all or nothing, yet California, each partner or shareholder can elect to participate in the regime. For some states, the returns, like Connecticut, for example, it's a combined partnership PTET return. New York has its own separate return. New Jersey allows you to participate in the composite and use the pass-through entity tax credits. Most other states will not. Some states have a flat rate, such as California at 9.3%, even though California's rate goes up to 12.3%. Most states, it's graduated. Also, for some states, like California, there are still withholding requirements in place, which you will probably need. And as far as overpayments go, most of the states at the individual level will allow for the overpayment to be refunded or credited. California, however, has a 5-year carryover requirement.
Wow, 5 years. So can you discuss how pass-through owners' cash might be impacted by the PTET?
Yeah, sure. So since the pass-through entity tax is allowing the owners to get a credit on their individual returns, it relieves them of paying estimated taxes as it relates to the pass-through entity tax or the pass-through entity income. Therefore, they're able to get a deduction at the federal level for both income tax and potentially self-employment tax, as well as using the credit on their personal state return. As such, firms don't need to make as large a tax distribution because of the benefit of both the deductibility federally as well as the credit for state purposes.
If the owners wind up with an overpayment, are refunds to the pass-through owners possible from the PTET credit?
Yeah, sure. So other than the specific situation with regard to California, for most state purposes, an overpayment can be refunded or credited. And for example, at the end of the day, those refunds, you're going to have to take a look to determine the taxability of the refund because the calculations could become a little convoluted due to the ordering rules inclusive of withholding as well as perhaps other estimated taxes.
So is it possible for a pass-through owner's share of PTET payments that could cover other income that they might have?
Yeah, sure. So for example, an owner may have other unsheltered income like investment income, or you could have a spouse that has lower withholding rates on their salary income. In addition, in New York City, for example, the pass-through entity tax, while it's a state level tax, because of the fact it could be at a higher rate at the entity level to calculate the credit compared to what the owner's personal income tax rate is, it could cover taxes like the New York City income tax as well.
So then how will the PTET economic dynamics change if there are multiple jurisdictions involved?
So economically, it generally makes sense to file for pass-through entity tax where a firm may be located, or if there's a state that it's fully non-resident in. However, once you get a non-headquartered state that you have some resident owners in, the economics can get really tricky. So let's look at an example. Let's say you have a New York-based firm, and therefore 100% of the income is apportioned to New York. Well, if the firm files in other non-resident states, whether PTE or not, there's going to be a resident credit allowed on the resident individual's returns. That could give rise to a refund, which could be taxable. So for example, if there's 100% New York, let's call it $100 tax, and there's a 10% New Jersey apportionment giving rise to a $10 tax. The $10 is going to reduce the New York liability, potentially creating a $10 taxable refund. If we elect into New Jersey's regime called BATE, then the partners or shareholders can offset the $10 refund with the additional $10 deduction. However, if you wind up with resident owners in New Jersey, in BATE, you're paying 100% of their income tax to New Jersey. Notwithstanding, they'll be entitled to almost a full credit for the New York state income tax on their personal returns. Therefore, if you have many resident partners, you're really laying out 200% in cash, and the 100% going to New Jersey is something the owners would never have covered in estimated taxes because of the resident credit they would get for the New York income tax. So therefore, you really have to look at the economics once you're moving into other states.
All right. Well, thanks, Steve. That was very informative. We would like to thank everyone for tuning into our vlog today. If you have any questions, please reach out to Steve, myself, or your Anchin relationship partner. And we look forward to seeing you for the next installment of Anchin's Law Talk.